This is going to be one of those stories that you tell your grandkids about. On December 2nd, 2025, something happened that nobody saw coming just 2 years ago. Vanguard Group, the world's second largest asset manager, began allowing ETFs and mutual funds that primarily hold cryptocurrencies to be traded on its platform. Now, before you shrug and say, okay, cool, another company adding Bitcoin, you need to understand something. This is Vanguard we're talking about. The company that literally led the charge against Bitcoin. The company that sparked a viral boycott movement. The company whose CEO went on video after video explaining why Bitcoin would never ever belong on their platform. And now, they've completely reversed course. This isn't just any policy change. This is the Wall Street equivalent of watching someone who's been screaming the sky is falling suddenly start selling umbrellas. And the story of how we got here is absolutely fascinating. So let me walk you through what actually happened, why it matters, and what this means for everyone watching. Let's start at the beginning. Vanguard isn't your typical investment company. Founded by the late Jack Bogle in 1975, this firm has always been different. They pioneered the index fund, they charge rock-bottom fees, and they have this unique structure where fund investors actually elect the board members and effectively own the company. They've attracted something of a cult following online because of this approach. In 2017, legendary investor Jack Bogle famously warned people to avoid Bitcoin like the plague, and Vanguard took that philosophy to heart. They didn't just avoid Bitcoin. They built their entire investment philosophy around the idea that you should only invest in assets that generate cash flows, stocks that pay dividends, bonds that pay interest, things you can model, value, and predict. Bitcoin? That didn't fit the mold. The Valley Forge, Pennsylvania-based firm, was founded by Bogle in 1975 on a bedrock of investing in stocks and bonds, assets that generate cash flow, dividends, and interest payments while eschewing commodities. Vanguard has traditionally avoided anything that Bogle dismissed as total speculation, and they applied that same thinking to Bitcoin with almost religious fervor. Now, when you understand this background, what happened in January 2024 becomes even more remarkable. The SEC approved spot Bitcoin ETFs. BlackRock launched one. Fidelity launched one. These became the fastest growing ETFs in history. Money poured in at a pace that shocked even the most optimistic Bitcoin bulls. And what did Vanguard do? They didn't just refuse to offer these products. When spot Bitcoin ETFs launched in January 2024, Vanguard immediately blocked all client access, triggering the hashtag Boycott Vanguard campaign across social media. Think about that for a second. Other brokerages were celebrating. Their customers were buying billions of dollars worth of Bitcoin ETFs, and Vanguard was actively blocking their customers from participating. Customers who tried to buy BlackRock Incorporated's iShares Bitcoin Trust encountered error messages stating trades could not be completed. The man leading this charge was Tim Buckley, a 33-year veteran of Vanguard who had worked for Jack Bogle himself. And Buckley didn't just quietly refuse to offer Bitcoin ETFs. He went on the offensive. In a recent video published by Vanguard, Buckley cautioned against including Bitcoin BTC ETFs in retirement investment plans due to the asset's volatile nature. His argument was actually pretty simple. Buckley said that Vanguard does not intend to change its stance toward the spot Bitcoin ETFs, primarily because it does not believe they belong in long-term and retirement portfolios. He pointed to Bitcoin's volatility. When stocks crashed in 2022, Bitcoin experienced a sharp decline alongside it. So much for being a hedge against traditional markets, right? According to Buckley, Bitcoin offers neither underlying cash flow nor easy-to-model future values, leading Vanguard to avoid offering Bitcoin ETFs. And then came the kicker. Responding to a webinar question on what it would take for it to launch a Bitcoin ETF, Buckley said, "We do not plan to, and we are not going to change our minds around this unless the asset class changes."
Spot Bitcoin ETFs. Question came in, hey, we know you're not offering one. Have you changed your mind? What would it take for you to change your mind? We don't plan to, and we're not going to change our minds around this unless the asset class changes.
Yep. Unless the asset class changes. That's a pretty firm statement. Bitcoin would need to fundamentally transform into something else before Vanguard would reconsider. But Buckley went even further. Buckley plans to retire before the end of 2024, but his departure is unlikely to change Vanguard's stance, as the beliefs are part of the firm's investment philosophy. So there you have it. The CEO saying never, and even suggesting that his departure wouldn't change anything because this was baked into Vanguard's DNA. Meanwhile, the hashtag Boycott Vanguard movement was gaining steam. Thousands of posts on social media, people threatening to pull their money. Customers were actually transferring accounts to Fidelity and Charles Schwab, who were happily offering Bitcoin ETFs. Now, if you want to understand why Vanguard eventually changed its mind, you need to understand what the boycott actually accomplished, or more accurately, what it didn't accomplish. Hashtag Boycott Vanguard started trending on X, accumulating thousands of posts, with users pledging to pull their money from the asset management giant. The crypto community was furious. They saw this as Vanguard being paternalistic, deciding what was best for their customers instead of giving them freedom to choose. And the boycott seemed to have real momentum. But then something interesting happened. Or rather, nothing happened. According to industry expert Dave Nadig, they won't lose a single 401k plan over it, and an infinitesimally small number of brokerage clients. He was right. Roughly $4.4 billion has been added to Vanguard's stable of 84 ETFs in the past week alone, after luring $157 billion in 2023. Money was still flooding into Vanguard. The company was growing. They were on the cusp of dethroning BlackRock as the #1 ETF provider. So, if the boycott didn't work, what changed? Well, two things happened that Vanguard couldn't ignore. First, the market proved them wrong about something fundamental. And second, someone new took over as CEO. Someone with a very different background. In February 2024, Tim Buckley announced he would retire at the end of the year. The crypto community immediately started speculating. Would the next CEO change course? Would Vanguard finally embrace Bitcoin? Most people assumed probably not. Vanguard had never hired a CEO from outside the company. They always promoted from within. It was part of their culture. And then, May 2024 happened. Vanguard announced that its board of directors has appointed Salim Ramji, a longtime financial services executive, as the company's new chief executive officer and a member of the board, effective July 8, 2024. Salim Ramji. From where? Oh, just BlackRock. You know, Vanguard's biggest competitor, the company that had just launched the most successful ETF in history, a Bitcoin ETF. Ramji took over in July 2024, and for 16 months, nothing changed. Ramji kept Vanguard's moratorium in place for more than a year. During that time, Bitcoin did something remarkable. It went from around 60,000 to an all-time high above 126,000 in October 2025. Vanguard clients watched from the sidelines, locked out of participating through their Vanguard accounts. Meanwhile, BlackRock's Bitcoin ETF kept growing. Fidelity's kept growing. New crypto ETFs launched. XRP ETFs attracted $756 million in investment since launching November 13, while Solana ETFs enjoyed $605 million in inflows since their October debut. The crypto ETF market was exploding, and Vanguard was still saying no. But behind the scenes, something was shifting. The regulatory environment was maturing. The administrative processes to service these types of funds have matured, and investor preferences continue to evolve, according to Vanguard's own statements later. More importantly, client demand wasn't going away. It was intensifying. Think about it from Vanguard's perspective. You're watching billions of dollars flow into Bitcoin ETFs. You're seeing competitors gain market share. You're hearing from customers who want access. And you're sitting on a $11 trillion platform with 50 million clients who are increasingly frustrated. At some point, the philosophy has to bend to reality. But it gets better. Ramji served as BlackRock's global head of iShares and index investments and was one of the firm's global executive committee members. This wasn't just any BlackRock executive. As the head of BlackRock's iShares division between 2019 and 2024, Salim Ramji helped launch one of the first spot Bitcoin exchange-traded funds ETFs in the United States. Let that sink in. Vanguard, the company that had spent the last year blocking Bitcoin ETFs, just hired the guy who helped create BlackRock's Bitcoin ETF. The very product that had become a $70 billion juggernaut and was crushing the competition. But here's what made it even more interesting. Ramji promptly told Barron's he has no plans to reverse Vanguard's crypto ban, adding that he will lead the company to growth within its long-standing culture with the zeal of a convert. So everyone thought, okay, false alarm, Ramji might have worked on Bitcoin at BlackRock, but he's going to respect Vanguard's culture, nothing's going to change. Except that's not what happened at all. Then came December 2nd, 2025. No fanfare, no big announcement ahead of time, just a simple policy change that sent shockwaves through the investment world. Starting on Tuesday, Vanguard will allow ETFs and mutual funds that primarily hold select cryptocurrencies, including Bitcoin, Ether, XRP, and Solana, to be eligible for trading on its platform. Just like that. After years of resistance, after the CEO went on record saying it would never happen, after blocking access even when competitors were offering it, Vanguard changed course completely. The timing was remarkable for another reason. It is a compromise that belies the firm's long-standing view that digital assets are too volatile and speculative for serious portfolios and comes despite a more than $1 trillion drawdown in crypto market value since early October. Bitcoin had crashed from its October high. It was down roughly 30%. The market was bleeding. And this is when Vanguard decided to open the floodgates. Most companies would wait for the market to recover, then ride in on positive momentum. Vanguard did the opposite. They jumped in during the correction. Some analysts saw this as genius timing. Others saw it as Vanguard finally bending to reality after running out of excuses. Persistent demand, retail and institutional, has spurred Vanguard's about face. The numbers tell the story. Since their January 2024 debut, spot Bitcoin ETFs have amassed billions in assets. Even after outflows and a decline in Bitcoin's price, Vanguard's biggest rival, BlackRock, has about $70 billion in its IBIT ETF alone. But Vanguard made sure to frame this carefully. Cryptocurrency ETFs and mutual funds have been tested through periods of market volatility, performing as designed while maintaining liquidity, said Andrew Kajeski, head of brokerage and investments at Vanguard. Translation: okay, fine. These things actually work. The infrastructure is solid. The administrative processes are mature. We can no longer use "it is too risky" as an excuse. And critically, the firm said it will support most crypto ETFs and mutual funds that meet regulatory standards, mirroring its treatment of other non-core asset classes like gold. Still, the firm will not be creating its own digital inventory anytime soon, so Vanguard is not launching its own Bitcoin ETF. They are not becoming crypto native. They are simply allowing their clients to buy third-party products. Think of it like how they handle gold. They let you buy gold ETFs, but they do not create their own. Now, let us talk about what this actually means in practical terms. This change opens access to crypto funds for more than 50 million brokerage customers who collectively oversee more than $11 trillion in assets. 50 million people, $11 trillion. Those are numbers that make every other development in crypto look small by comparison. But before you start thinking this means $11 trillion is about to flood into Bitcoin, let us be realistic. The addressable market for these products is narrower because only self-directed brokerage and IRA accounts are authorized to trade them. Institutional mandates, defined benefit plans, and other pooled vehicles generally remain restricted from such allocations. Still, even a tiny fraction of that $11 trillion represents massive buying power. Even if only 10% of Vanguard clients allocate 1% to Bitcoin ETFs, that represents approximately $11 billion in buying pressure. And remember, Bitcoin's entire market cap fluctuates on much smaller numbers than that. But there is something even more interesting happening beyond just the raw dollars. Vanguard clients exhibit behavior distinct from the active traders who drove early crypto ETF inflows. These are not day traders. These are not people looking to make a quick buck. These are buy and hold investors who rebalance their portfolios quarterly or annually. And that creates a fascinating dynamic. In a standard 60-40-1 portfolio allocated to equities, bonds, and crypto, respectively, automated systems maintain target weightings by selling outperforming assets and buying underperforming ones. If the price of Bitcoin or Solana drops, the portfolio algorithmically buys more to restore the 1% weighting. This is what is called systematic buying pressure. It is not emotional. It is not based on news or hype. It is simply rebalancing to maintain target allocations. And that could fundamentally change how Bitcoin behaves during corrections. Instead of panic selling, you would have automatic buying kicking in at lower prices. So let us circle back to Salim Ramji for a moment, because his role in this story is absolutely crucial. 16 months after leaving BlackRock to become the CEO of Vanguard, Ramji has steered the world's second-largest asset manager in a similar direction. But he did it his way. While less so than his predecessor, Ramji's position on crypto remains cautious. The Vanguard CEO has never expressed any special enthusiasm for the asset class. This was not about Ramji being a Bitcoin fanatic. While still at BlackRock, he framed Bitcoin ETFs in terms of expanding access to new asset classes without exposing investors to undue risk. That framing is important. Ramji did not come in and try to transform Vanguard into a crypto company. He simply made the practical argument that if these products are regulated and tested and clients want them, then the platform should offer them. It is about customer choice, not ideological conversion. And the way he handled it was actually quite clever. He waited. He let the products prove themselves through market cycles. He let the infrastructure mature. He let the regulatory framework solidify. And then, when the moment was right, he made the change. No big celebration, no press tour, just a quiet policy shift that fundamentally altered the landscape. Now, here is what makes this whole situation even more fascinating. The timing of Vanguard's announcement coincided with some serious market turbulence. BlackRock's Bitcoin ETF has experienced over $2.7 billion in redemptions over the past 5 weeks, marking its heaviest outflow cycle since its launch. Investors yanked more than $2.7 billion from the exchange-traded fund over the 5 weeks to November 28th. So right as Vanguard is opening the doors, money is flowing out of Bitcoin ETFs at a record pace. What is going on? The decision arrives during turbulent times for crypto markets. Bitcoin currently trades around $90,210, down roughly 30% from its October peak above $126,000. The entire crypto market had shed over $1 trillion in value since October, and institutional investors were pulling back. The reversal follows October's sharp crypto market liquidation, which erased more than $1 trillion in value and halted IBIT's months of steady inflows. So all that momentum from earlier in the year had completely reversed. The institutions that had been buying were now selling. Some people looked at this and thought, what terrible timing for Vanguard. You finally opened the doors right as everyone else is running for the exits. But others saw it differently. Entering during a 30% correction from all-time highs provides better risk and reward than buying at October peaks. Think about it. If Vanguard had opened access in October, when Bitcoin was at $126,000, what would have happened? Their clients would have bought the absolute top, then watched their investments drop 30% in a matter of weeks. The boycott Vanguard people would have been replaced by angry clients demanding to know why Vanguard let them buy at such inflated prices. Instead, Vanguard's clients can now dollar cost average in during a correction. They are getting better entry prices. They are not buying the euphoria, they are buying the dip. Whether that was intentional strategy or accidental timing, it is actually pretty smart from a risk management perspective. So, what is the actual significance of all this? Why does Vanguard's reversal matter beyond just being an interesting story? Well, there are several layers to unpack. First, the move effectively eliminates the last major institutional barrier, preventing everyday United States investors from accessing crypto through regulated ETF products. Every major brokerage now offers Bitcoin ETFs. Fidelity, check. Charles Schwab, check. TD Ameritrade, check. Even the super conservative Vanguard, Check. There is nowhere left to hide for the skeptics. Second, this validates the maturation of crypto infrastructure. Remember, Vanguard's entire argument against Bitcoin was that it was too volatile, too speculative, and too immature for serious investors. According to a Bloomberg report, Vanguard's head of brokerage and investments said that crypto ETFs and mutual funds have operated exactly as intended. They continued to function smoothly even during periods of significant market volatility. So the infrastructure worked. The ETFs performed as designed. The liquidity held up. The administrative processes matured. Vanguard had to acknowledge that its concerns about operational risk had been addressed. Third, this changes the conversation around retirement portfolios. Bank of America has expanded crypto access for its wealth management clients, with internal analyses recommending modest 1 to 4% allocations for suitable risk-aware investors. Major financial institutions are now actively recommending small crypto allocations as part of diversified portfolios. That's a complete 180 from just 2 years ago, when most wealth advisors wouldn't touch crypto with a 10-foot pole. Now it's becoming standard practice to at least consider a small allocation. And with Vanguard on board, that trend is only going to accelerate. But there's something bigger happening that most people aren't connecting. This Vanguard reversal isn't happening in isolation. Vanguard's shift aligns with a broader trend in late 2025. Let me explain what I mean. Throughout 2024 and 2025, there's been this massive shift in how traditional finance views crypto. It started with the spot Bitcoin ETF approvals in January 2024, but that was just the beginning. Since then, we've seen major banks launch crypto trading desks. We've seen pension funds quietly add Bitcoin exposure. We've seen sovereign wealth funds exploring digital assets. Spot Bitcoin ETFs have drawn tens of billions of dollars in total inflows since early 2024 and rank among the most successful ETF debuts ever. This isn't hype. This isn't retail FOMO. This is institutional capital flowing into regulated products at a pace that has shocked even the most optimistic projections. And the regulatory environment has fundamentally changed. The SEC, under Gary Gensler, was hostile to crypto. But the approval of spot Bitcoin ETFs opened the floodgates. Now we're seeing approvals for Ethereum ETFs, XRP ETFs, Solana ETFs. The playbook is established. The framework exists. So when Vanguard makes this move, they're not pioneers. They're actually among the last to adopt. But that's typical for Vanguard. They've always been conservative. They've always waited for things to prove themselves. And the fact that they're finally coming around is itself a signal that crypto has crossed a legitimacy threshold that seemed impossible just a few years ago. Quick pause here. If you're finding this deep dive valuable, make sure to subscribe to the channel. The crypto space moves incredibly fast, and these institutional shifts are happening almost weekly now. I try to cut through the noise and focus on the stories that actually matter for understanding where this market is heading. The subscribe button helps me keep making these videos, and it ensures you don't miss the next major development. Now, I want to be balanced here. Just because Vanguard reversed course doesn't mean all their original concerns were wrong. Despite recent volatility, institutional appetite for regulated crypto exposure remains strong. That volatility is real. A 30% drawdown in 2 months would devastate most traditional assets. If the S&P 500 dropped 30% in 2 months, we'd be talking about a market crash, emergency Fed meetings, the whole 9 yards. But in crypto, it's just called a correction. So when Tim Buckley said Bitcoin was too volatile for retirement accounts, he wasn't wrong about the volatility part. He was just wrong about whether people should have the choice to include it anyway. And that's an important distinction. There's also the question of whether crypto actually serves a useful purpose in a portfolio. The original pitch was that Bitcoin would be digital gold, a hedge against inflation, uncorrelated to traditional markets, and a safe haven during uncertainty. But when stocks got hammered in the recent crisis, Bitcoin went right with them, according to Buckley's earlier arguments. That correlation with risk assets is a legitimate concern. If Bitcoin crashes whenever stocks crash, what's the diversification benefit? You might as well just own more stocks. Of course, Bitcoin bulls would argue that we haven't seen enough market cycles yet to judge this properly. And they'd point to other periods when Bitcoin did act as an inflation hedge. The jury is still out. But let's talk about what I think is the most interesting aspect of this whole story, the game theory. Because Vanguard's reversal wasn't really about Bitcoin proving itself. It was about competitive pressure and market dynamics. Vanguard's reversal followed sustained pressure from multiple directions. Clients had requested access to regulated crypto products for years, with many transferring accounts to competitors like Fidelity and Charles Schwab that embraced digital assets earlier. That's the key sentence right there. Clients were leaving. Not in droves, not enough to hurt Vanguard's overall growth, but it was happening. And more importantly, Vanguard was becoming known as the place you couldn't access crypto. That's a branding problem when you're trying to attract younger investors. So this wasn't really about Vanguard changing their mind about Bitcoin. It was about Vanguard realizing they couldn't afford to be the only major brokerage that didn't offer access. Once BlackRock, Fidelity, Schwab, and everyone else had jumped in, Vanguard's position became untenable. And Salim Ramji, coming from BlackRock, understood this better than anyone. He'd seen firsthand how successful IBIT had been. He knew the demand was real. He knew the infrastructure worked. So when he took over at Vanguard, it wasn't a question of if they'd reverse course, but when and how. The answer was to wait 16 months, let things mature, then make the change quietly without making a big deal about it. No admission that they were wrong, no apology to the hashtag boycott Vanguard people. Just a simple policy change framed as responding to client preferences and market maturation. So what happens next? Well, there are a few scenarios worth considering. The optimistic case is that if only a fraction of Vanguard's client base allocates a standard 1% to 2% satellite position to crypto ETFs, it represents tens of billions of dollars in net new capital. That capital would flow into the market gradually, not all at once, but over time, it could provide sustained buying pressure that supports higher price levels. And remember, unlike retail traders who might sell during corrections, ETF holders tend toward buy and hold behavior. Retirement accounts and long-term portfolios create sticky demand that doesn't fluctuate with daily price movements. This is fundamentally different from the 2017 bull run, which was driven by retail FOMO and leverage. This is pension funds, 401k plans, and long-term investment accounts slowly adding crypto exposure as a portfolio diversifier. That's a much more stable foundation for sustained growth. The pessimistic case is that Vanguard's clients, being more conservative by nature, simply don't allocate meaningful capital to crypto. Maybe they look at the volatility and say, no thanks. Maybe their financial advisors recommend against it. Maybe the 30% correction from October scared away the exact demographic that Vanguard serves. If that happens, this whole reversal becomes a footnote. Access expands, but demand doesn't materialize. The market continues to be driven by the same players who were already involved. Nothing fundamentally changes. But I think the reality will be somewhere in between. Some Vanguard clients will allocate, many won't. But the mere fact that it's now an option normalizes crypto in a way that nothing else could. When the world's most conservative investment firm says, okay, you can buy Bitcoin ETFs if you want, that sends a powerful signal to everyone else who's been sitting on the sidelines. You want to know what the most ironic part of this whole thing is? Vanguard's 2-year delay cost clients significant opportunity. Bitcoin traded as low as $15,000 in late 2022 and reached $126,000 in October 2025. An 8 times return that Vanguard clients were prevented from accessing through regulated ETF wrappers. So all that time Tim Buckley spent protecting Vanguard clients from the dangers of Bitcoin, he was actually protecting them from an 8 times return. Now, you can argue that clients could have bought Bitcoin elsewhere. They could have opened accounts at Fidelity or Schwab. They could have bought actual Bitcoin on exchanges. That's all true. But the reality is most people don't do that. They invest where they already have accounts. They use the tools and platforms they're familiar with. By blocking access, Vanguard wasn't protecting their clients. They were just making it harder for them to participate in one of the best performing assets of the past few years. And now that they're opening access during a 30% correction, those same clients might look at the chart and think, I'll wait for it to go lower. Classic buy high. Sell low psychology. The irony is almost too perfect. So what are the actual lessons from this entire saga? I think there are several worth noting. First, institutional resistance to crypto is crumbling faster than anyone expected. 2 years ago, Vanguard was adamant they would never offer Bitcoin ETFs. Today, they do. What seemed like an unmovable position turned out to be quite movable when market forces demanded it. Second, competitive pressure works. The hashtag boycott Vanguard movement claims credit for forcing the reversal, suggesting Vanguard acted from necessity rather than conviction. Whether that's true or not, it's clear that Vanguard could not maintain their position while every competitor was offering access. Third, timing matters more than you think. Entering during a 30% correction from all-time highs provides better risk and reward than buying at October peaks. Sometimes being late to the party is actually an advantage, especially if it means you're buying during a correction instead of at the top. Fourth, infrastructure and regulation matter. Vanguard's entire argument eventually shifted from Bitcoin is bad to okay, but the infrastructure isn't ready. Once that infrastructure proved itself, they ran out of excuses. This is why regulatory clarity and robust ETF frameworks are so important for institutional adoption. And fifth, change happens slowly until it happens quickly. Vanguard resisted for years, then reversed course with barely any warning. That is how institutional adoption works. Long periods of resistance followed by sudden capitulation. So is this the most dramatic Bitcoin policy shift ever made by Vanguard? Absolutely. Going from avoid Bitcoin like the plague to offering Bitcoin ETFs is about as dramatic as it gets. The CEO went on record saying it would never happen. Then it happened. But more importantly, this represents a milestone in crypto's journey from fringe speculation to mainstream asset class. When the most conservative major investment firm in America finally says, okay, you can buy Bitcoin if you want, that is a bigger deal than any Bitcoin price milestone or market cap achievement. Because what this really shows is that institutional resistance is finite. Companies can only ignore client demand and competitive pressure for so long. Eventually, they adapt, or they lose market share. Vanguard chose to adapt. And in doing so, they have opened the door for millions of conservative investors who would never have bought Bitcoin on Coinbase but might allocate 1% through their Vanguard account. The story of how we got here is fascinating. A legendary founder who hated Bitcoin, a CEO who doubled down on that position, a viral boycott that did not quite work, a new CEO from the competition who quietly reversed course, and a policy shift that happened during a market correction of all times. You really cannot make this stuff up. And whatever happens with Bitcoin's price from here, this moment will be remembered as the point when even the most stubborn institutional holdouts finally capitulated. Not because they believed in Bitcoin, but because reality demanded it. And sometimes that is how progress happens. If you made it this far, I would love to hear your thoughts. Did Vanguard wait too long? Was this smart timing or forced capitulation? And what do you think happens next, now that literally every major brokerage offers Bitcoin ETFs? Drop your thoughts in the comments below. And as always, I hope you have a wonderful rest of your day. Smash the like button. I'll see you